We tested one of private equity's favorite screens across 22 global exchanges over 25 years. Net debt to EBITDA below 2 times. In the US, it underperformed the S&P 500 by 2.89% per year. In India, the compound annual growth rate was 17.62%, with 108.6% of capture and just 65.9% down capture versus the Sensex. Same signal, opposite outcomes. The exchange you apply it to matters more than the signal itself. The universe is the full exchange, not index-constrained. NYSE, NASDAQ, and AMEX for the US, with market cap above $1 billion. We use the full market because the S&P 500 is itself a curated list of quality companies. Testing a leverage filter inside an already quality filter universe inflates results. The screen requires net debt to EBITDA below 2.0x, above negative 5.0x to filter extreme net cash distortions, and return on equity above 10%. The top 30 stocks by lowest net debt to EBITDA form the portfolio. Equal weight, rebalanced quarterly. Point-in-time data with a 45-day lag ensures no look-ahead bias. Size tier transaction costs reflect that larger stocks are cheaper to trade. We rebalance quarterly because annual and interim reports filter in throughout the year, and quarterly refresh picks up the latest filings. We tested this on 22 exchanges. Private equity, or PE. Firms use net debt to earnings before interest, taxes, depreciation, and amortization below 2 times as a core screen when evaluating acquisition targets. Conservative balance sheets plus strong operating earnings equals resilience. The hypothesis is that this PE firm logic translates to public equity screening. Companies with low leverage relative to cash generation should weather credit crunches better and compound more steadily. If the hypothesis holds, you'd expect lower drawdowns during credit stress. In 2008, over-leveraged companies should fall harder while conservative ones hold up. You'd also expect moderate outperformance during normal markets and potential lag during leveraged growth rallies when borrowing aggressively to fund expansion gets rewarded. In practice, this is a bet that low leverage provides downside protection, and that strong return on equity within a low leverage framework identifies genuine business quality. The US result first. 5.13% compound annual growth rate versus 8.02% for the S&P 500. That's negative 2.89% excess per year. $10,000 grew to $36,243 versus $72,209 for SPY. The S&P 500 ETF. The up and down capture tells the story: 120% of gains, but 150% of losses. Higher risk, lower return. The worst possible combination. The strategy's annualized volatility was 25.4% versus 16.7% for SPY. More risk, less reward, and a Sharpe ratio of 0.123, that's barely above zero. The year-by-year data reveals 2 distinct eras for this strategy. The early years looked promising. In 2001, when over-leveraged companies collapsed, low-debt companies held up. The strategy gained 1.4% while SPY fell 9.2%. Then 2003 delivered a spectacular 44.8% return, more than doubling SPY's 24.1%. 2006 saw the strategy return 30.2% versus SPY's 13.7%. Companies that didn't need cheap debt were the anti-leverage trade. Then the picture changed. The 2008 financial crisis hit the strategy harder than the benchmark, falling 41.7% versus SPY's 34.3%. The promised downside protection from conservative balance sheets didn't materialize when the entire financial system was under stress, and the real damage came later: negative 22.6% excess in 2019, negative 38.1% in 2021, negative 34.0% in 2023, and negative 23.3% in 2025. These aren't market crashes. SPY was strongly positive in all those years. The strategy missed the mega-cap tech rally that has driven the S&P 500 since 2015, and that gap has continued into 2024 and 2025. The global results tell a completely different story. India produced the best result. $10,000 grew to $654,068. The capture ratios are strong: 108.6% of Sensex gains and only 65.9% of losses. In 2022, the India portfolio gained 10.2% while most global markets fell. In 2009, the India portfolio gained 116.4% versus the Sensex's 76.3%. More upside capture than downside. Sweden had a Sharpe ratio of 0.414, reflecting steady industrial compounding from companies like Sandvik, Atlas Copco, and Hexagon. $10 grew to $126.475 pints. Against the OMX30 local benchmark, excess was plus 7.18% annually. Down capture of 62.7% means the strategy absorbed only about 2/3 of the OMX30's losses. 13 of the 22 exchanges beat their local benchmark. Many exchanges that looked bad versus SPY actually beat their home index. Korea beat KOSPI by 1.98%. Germany beat DAX by 2.06%. China beat the SSE Composite by 3.16%. Hong Kong beat the Hang Seng by 2.43%. And Taiwan beat TAIEX by 1.97%. The signal works better than SPY comparison suggested once you measure against the right benchmark. 3 patterns explain most of the spread across 22 exchanges. Emerging markets reward the signal more because tighter credit conditions mean a larger premium for financial conservatism. India, Brazil, Thailand, and China all outperformed their local benchmarks. India's result is particularly instructive. Tighter credit means conservative balance sheets carry real weight. The return on equity above 10% filter is more selective in a market where consistent profitability requires real competitive advantage. And India's equity market isn't concentrated in mega-cap tech the way SPY is. High cash periods hurt performance on exchanges where fewer than 10 stocks qualified regularly. Israel at 28% cash, Saudi Arabia at 28%, Taiwan at 20%, and Korea at 22% all suffered from being uninvested too often. When you're sitting in cash a quarter of the time, compounding stalls. These smaller exchanges simply don't have enough large-cap companies that pass all 3 filters simultaneously. The mega-cap benchmark problem explains the U.S. failure. SPY's returns since 2015 are driven by 5 to 10 tech companies. NVIDIA, Apple, Meta, Alphabet. A 30-stock fundamental screen rarely includes these at the weights that drive SPY returns. The strategies companies aren't bad. The benchmark changed around them. PE firms apply this filter inside a pre-screened universe of deal-quality businesses. Low debt among deal-quality businesses is fundamentally different from low debt among 22,000 listed U.S. stocks. The U.S. result is an honest underperformance. If you're running this screen on U.S. stocks expecting to beat SPY, 25 years of data says it won't. The companies selected are decent businesses. But the benchmark is increasingly hard to beat for any non-momentum fundamental screen. If you want to use this signal on U.S. stocks, the better question isn't whether it beats SPY. It's whether it serves as a replacement for a value or quality factor ETF. Brazil's result illustrates a framing problem. Its 10.16% compound annual growth rate beats Bovespa by 1.21%, but Brazil's risk-free rate is 10.5%. The strategy doesn't beat Brazilian government bonds. That's a real consideration for any Brazilian investor. Transaction costs also played a role. Quarterly rebalancing of 30 equal-weight positions isn't cheap. The results include realistic size tier costs, but they contribute to the drag. This is a single factor. Combining with momentum, quality signals, or sector restrictions would change the results. The signal captures something real about financial resilience, but in isolation on a broad U.S. universe, it doesn't generate alpha. That's what the data shows across 22 exchanges and 25 years. Full results, charts, and the year-by-year breakdown are on the blog at cetaresearch.com. Link in the description. The backtest code is open source at github.com/Ceta Research/backtests. Run any of the 22 exchanges and see exact results. Subscribe for more backtested strategies every week.